Imagine a company that forever changed the way we travel, a company with margins that any big tech firm would envy. Yet look at this chart from the day it went public. In 2020 the stock has moved sideways. I think the market is dead wrong, and today I will show you why. If you think Airbnb is a stagnant company, get ready to change your mind. In the first quarter of 2026, Airbnb literally crushed both its official guidance and analyst estimates. Revenue 18% year-over-year. The company's own guidance was 14 to 16% beaten. Gross booking value. The total money spent on the platform 19% year-over-year, nearly $30 billion in a single quarter. And pay attention to this. Growth is accelerating compared to previous quarters, not slowing down. There is a detail almost nobody highlighted. These exceptional numbers were achieved during the outbreak of the Middle East conflict, which triggered a massive wave of sudden cancellations across the region. Despite this powerful headwind, the business showed remarkable organic resilience. Management has already raised full-year 2026 guidance from low double-digit growth to low to mid-teens, meaning 12 to 16%. This is not a stagnant company, this is a company reaccelerating. Let's talk about Airbnb's real competitive advantage. I need you to pay close attention here, because this is something most investors simply do not see. Let's start with the most misunderstood moat, the brand. Whenever I hear an investor say, yes, Airbnb has a strong brand, I always stop and ask, what exactly do you mean? Because in most people's heads, strong brand means brand awareness, being known by many people. Amazon is known by everyone, Nike is known by everyone, McDonald's is known by everyone. But being known is not a moat. It is the result of spending billions on marketing. Brand as economic moat is something entirely different. A brand becomes a moat when a company has built, over time, through repeated experiences, a level of trust, status, or uncertainty reduction so deeply embedded in the consumer's mind that they are willing to pay a premium over competitors without even comparing alternatives. Notice the difference. It is not I know you. It is I trust you so much I don't even need to look elsewhere. This type of advantage has precise characteristics. Being top of mind for a brand helps reduce customer acquisition costs and command higher prices. A strong brand reduces search costs for consumers. They go straight to the brand without considering competitors. This raises purchase propensity and lowers customer acquisition cost. The product or service quality doesn't necessarily need to be superior to competitors, but the perceived quality must be higher than competitors. The direct consequence of all this is pricing power. When a consumer does not compare, they are not as price sensitive. They know Airbnb will cost a certain amount. If that amount feels reasonable relative to their expectations, they pay without hesitation. Data confirms this in a crystal clear terms. The average daily rate, ADR, has jumped to $187, up 9% year over year. And demand has not dropped, it has accelerated. So I raise prices and people keep buying. That is exactly what is happening. Another interesting info is that vast majority of Airbnb's traffic is direct. So no Google, no price comparison sites, no paid advertising to bring users to the platform. Traditional online travel agencies like Booking or Expedia spend billions of dollars every year on marketing just to appear ahead of Airbnb in search results, because they know that if a user lands on Google without a destination in mind, there is still a chance to compete for the booking. But if the user opens the Airbnb app directly without going through Google, the battle is already lost, and increasingly this is exactly what happens. This translates into a massive structural advantage. While competitors burn margins on advertising, Airbnb reinvests that difference into product buybacks and expansions. Now let's talk about network effects. And here there is fundamental distinction most analysts miss. Network effects could be local or global. Uber, for example, has a local network. If you are in Rome, you book a ride in Rome. A local competitor can enter your city and erode margins. Airbnb has global network effects. A user in Rome opens the app and finds listing in New York, Tokyo, Bali. The platform's value grows with every host who signs up anywhere in the world. This creates two types of self-reinforcing loops. Direct: the more guests there are, the more hosts join, the more valuable the platform becomes for everyone. And indirect: the more hosts there are, the wider the selection, the more guests arrive. It is a flywheel spinning ever faster, and competitors must fight it at a global scale. So why, with all these advantages, does Wall Street keep looking the other way? The problem is that Wall Street wants everything now. In Q1, nights and experiences grew 9% year-over-year. For Wall Street algorithms accustomed to double-digit growth, 9% smells like a slowdown. While nights grow 9%, revenue grows 18%, and gross booking value grows 19%. Airbnb does not need to double the number of rooms sold every year. Thanks to pricing power, it earns far more from each individual booking. And without the Middle East geopolitical impact, roughly 1 percentage point, we would already be at 10%. Before getting to the valuation, I want to show you what is changing inside the company. RNPL, reserve now, pay later. 20% of all money spent on the platform is generated through the book now, pay later service. Payment flexibility leads people to book longer and more expensive trips. Airbnb manages to lock in bookings months in advance, pulling customers away from the competition before the summer season even begins. 60% of all company code is written with AI, roughly double the tech industry average. 40% of customer service issues are fully resolved by AI with no human intervention. Concrete result: operating cost per booking has dropped 10% year-over-year. Nearly 1 in 4 new guests who book an experience ends up booking a stay on the platform. About 1 in 3 people who choose an experience also books accommodation within the following 90 days. The app is transforming into a perfect circular ecosystem. So Wall Street values Airbnb as a vacation listing website, but the company is transforming to something far larger, a complete travel ecosystem. CEO Brian Chesky has been clear: the target is to launch at least one new business per year capable of generating at least $1 billion in annual revenue at scale. Let's talk through the optionalities Airbnb has and how the business could evolve. So the first one is advertising. Expedia and Booking monetize between 1 and 2% of their gross merchandise value through advertising. With a gross booking value of $100 billion and a take rate of 1.5%, Airbnb could generate $1.5 billion from this channel alone. Optionality number 2: payment products. Airbnb handles enormous payment flows and currently pays billions in processing fees to third parties. An optionality could be internalized payments, just as Shopify did with Shopify Payment. Optionality number 3: airport transfers, grocery delivery, luggage storage, car rental. Optionality number 4: long-term stays. So long-term stays carry high growth potential, especially with the expansion of remote work. Optionality number 5: card membership. An annual subscription for guests, like Amazon Prime, but for travel. Discounts on bookings, early access to the most in-demand listings, flexible cancellations, priority customer service, stuff like that. A membership at $99 or $150 per year, something like that. So what is Airbnb really worth? Airbnb shows free cash flow margins between 35% and 40%, but the company makes very generous use of stock-based compensation. So subtracting this, the real margin drops to approximately 25%. We will use this 25% as our base case. So let's run a reverse discounted cash flow. And right now, using a free cash flow margin of 35%, the current share price of $134 implies an annual free cash flow growth rate of 7.5%. It's a very conservative number, also because the discount rate is 10% and the terminal growth rate is 1.5%. So let's change these values, and we used free cash flow margin of 25%. I want exit multiple of free cash flow, so I would say 20x. Discount rate of 12%, and I think a growth rate of 10% could work exactly. So, with a free cash flow margin of 25%, the implied free cash flow growth is 10% to justify the today stock price. Okay, I think it's perfectly achievable, but let's analyze it more deeply using a classic discounted cash flow model with exit multiple, the model most commonly used on the buy side. Okay, so let's download the Excel model, select the correct terminal value method, and download everything. Here we have a DCF already built with analyst estimates for the first 5 years and then average values. Our task is to understand whether these estimates make sense to us or whether analysts are underestimating or overestimating the company. To do this, we'll try to estimate revenues starting from KPIs and market growth estimates. So we calculate gross booking value starting from ADR and the number of nights and experiences booked. Once we have calculated gross booking value, we assume a take rate and obtain revenue. For ADR, looking at past data and considering all the optionalities listed previously, I would say we can use a base case of 1.5% growth. For nights booked, I would use a growth estimate roughly equivalent to that of the online travel agency TAM. And for the take rate, I would leave it unchanged in the base case. This way, we get revenue growth of around 9.5% per year. Comparing it with analyst estimates, first 5 years, we see that the numbers aren't too far apart. So I will take the analyst's first 5 years of estimates as good and then add my own estimates. Let's enter the data into the model. Now let's validate EBIT. Management has declared an EBITDA margin of at least 35%. Since EBIT is practically equal to EBITDA, D&A nearly zero, I would say we can consider an EBIT of 33%, accounting for the impact that future optionalities could have. For interest income, I would put 4%. Interest expense, I would leave at zero. And for other income expense, I would leave -1%. For taxes, I would say 20% of ABT works fine. D&A will leave the average values. Stock-based comp we zero out. Change in non-cash working capital, I would leave at 0% as the base case. Capital expenditure, I would leave the average values. We get a share price of $144 with an internal rate of return of 13%, discount rate of 12%, and free cash flow exit multiple of 20x. We notice that free cash flow margin is around 28%, lower than the past years. This is because we have completely removed stock-based compensation. So even removing stock-based comp, we can see that Airbnb has an intrinsic value greater than what Wall Street assigns to it. Now let's look at the optimistic case. ADR growth of 1.75% per year. Nights booked I would increase to 8.5%. Take rate I would increase by 0.5% per year. Here too we see that the numbers aren't very far from analyst estimates, so I will keep those, and for the following 5 years we insert our own data. EBIT, this time I would leave the one estimated by analysts, which is in line with management statements. Tax rate I would lower to 19%. The rest I would leave as is. Expect change in non-cash working capital, which I will set at 0.5%. With these values and a 25x free cash flow exit multiple, we get a share price of $211 and an internal rate of return of 18%. We conclude with the conservative case in which we'll zero out ADR growth and reduce nights booked growth to 6% per year. Also reduce the take rate by 0.5% per year. Our estimates are more pessimistic than the analysts, but here too I will use their estimates for the first 5 years and then put in ours. EBIT I will set at 30%, tax rate 22%. For the rest, I would leave everything the same except change in non-cash working capital, which I will set at -0.5%. With these values and an exit multiple of 15x free cash flow, we get a share price of $78 and an internal rate of return of 4.55%. Now, if we calculate an expected value as assigning probabilities to each scenario, we get how much the stock is worth taking all 3 scenarios into account. So base scenario has a share value of $144, exit multiple 20x, and I would assign a probability of 60%. Optimistic scenario has a share value of $211, exit multiple 25x, and I will give it a probability of 25%. Conservative case has a share price of $78, exit multiple 15x. I will give it a probability of 15%. The resulting value is $160. So Airbnb is worth around $160 per share according to these estimates. It's never a precise figure down to the last decimal. You should always think of it as it's worth approximately this. Now, to always stay up to date quarter by quarter on the business performance, I've saved these charts in the My Workspace section of Airbnb. So here we can see revenue, operating margin, gross booking value, ADR, take rate, free cash flow, and free cash flow margin. This way I can tell whether the thesis is on track, and if something looks off I can immediately go and check the earnings call transcript to see if it's been addressed. I hope you enjoyed the video. If you want to build these discounted cash flows yourself, you can find them at justdcf.com along with fundamentals, KPIs, analyst estimate, investment theses written by other investors and more. So take care and see you soon.